Welcome to today's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me today, as usual, is Jonathan Charlo, also a partner of the firm and our lead analyst. Today's webinar is scheduled to last 45 minutes to 60 minutes, and a copy will be posted to the SilverOak website afterwards. If you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session. And if you're not working with a SilverOak advisor, feel free to contact me directly at 952-896-5701. And of course, I want to thank Jonathan and the rest of SilverOak's team that put the materials together and make this webinar possible. It is a lot of work in a relatively short period of time. For compliance purposes, I must note we'll be discussing the overall markets and economy during today's webinar. In doing so, we'll be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each client has a customized portfolio. Nonetheless, all of our clients should have received their customized performance reports within the last week or two. If you have any specific questions on those reports, please feel free to reach out to your SilverOak advisor if they've not contacted you already. And lastly, as we always say, past performance is no guarantee of future success. So with that, Jonathan, let's take a look at the agenda. We've kept the typical structure where we'll talk about the economy and walk through SilverOak's dashboard first. Then we'll transition into a discussion about market performance, then discuss SilverOak's outlook as we move forward. We do have an entire section today on the recently passed legislation and at least the major components of that bill that was signed into law. And we will wrap it up with some brief SilverOak updates. And again, encourage everybody to reach out to their advisor with questions. We did have a few questions come in before today's webinar that we have tried to address throughout the discussion that we'll have here over the next 45 to 60 minutes. So Jonathan, let's start with the economy and the dashboard, and just touch base, if you don't mind, on kind of where things are as it relates to the various components of the dashboard.
So while we've seen a lot of volatility in the markets, what we haven't necessarily seen is a lot of volatility in the economy. We've seen some little bit of changes on the margin, but it has remained neutral for purposes of the dashboard.
And we project might even go into the positive.
Might even go into the positive, yes.
So that's the economy. How about the credit markets?
Credit markets have actually improved just a little bit. You can see that with the light green. And again, with our projection, things are looking a little bit better later in the year as well.
Now, valuations have remained in the red, which means not necessarily good because they're high. Of course, everybody that's in the market having high valuations is a positive.
Yeah, we've seen multiples expand in US markets over the last several years. In prior webinars, we've talked about the Mag 7, their relatively high valuations. Certainly there are areas of the market that are not as expensive, but in aggregate, we do list it as a negative.
And we've said many, many times in our webinars, you can have high valuations for very long periods. And as a matter of fact, later we have a slide that talks about when should you be investing, and everybody gets concerned about investing at the high. But if we look at the data that we're going to see in a few minutes, I don't know. There's not a lot of support for trying to time or wait for the dips. But we'll touch on that a little later in today's discussion. The last component of the dashboard, market sentiment. And we're showing here that it's turning positive.
Yeah, it was down briefly, obviously, when the markets were down over the concern of the reciprocal tariff rates. But with kind of Trump backing off of those levels, we did see a very, very rapid recovery in the markets. And so as a result, market sentiment is now actually fairly positive.
Yeah, I saw the Michigan numbers that recently came out was 61.8 up from 60.7, I think. So that's headed in the right direction. And I think inflation expectations cooled as well with the recent release of data. So
yeah, they have come down a little bit.
So in total, the composite still remains in what we refer to as the neutral category. But if we look here on this next chart, we'll show the dashboard going back, and this has the 6-month average dashboard in yellow, I believe, with the dashboard composite in black. And we can see here on the far right that the data is improving. It's kind of in that upward momentum off of what was a really brief, very brief dip.
Yeah, and actually, if you look at the composite or the black, you can see it's really not far off from where it was before all of this. So almost getting slightly close to positive.
Got it. So let's break down a couple of the components of the composite. So for the economy, let's touch on the ISM indices.
So we've seen those come down in the last year, last 6 months, but those are kind of bouncing, but they're really not that negative.
Okay. Also with the economy, unemployment.
We've basically seen unemployment kind of within a range, and if we look kind of down there, most recently, it actually ticked down a little bit.
Yeah, I think jobless claims that just came out, the weekly jobless claims were down too. I think they were down 7,000. So that's a positive. Here's one that hasn't been quite as positive.
Yeah, and the issue with the housing market and housing starts is our relatively high mortgage interest rates. Now, historically, they're not high, but relative to where we were at pandemic lows, they are high, and it has caused first-time home buyers to kind of sit on the sidelines. Affordability indices are not favorable. So this is certainly one part of the economy that would benefit from lower interest rates.
Yeah, and the most recent data that came out, I think the starts hit an 11-month low, and building permits were kind of down at a 2-year low, if I recall. And building permits are important because that's considered to be kind of a forward indicator, leading indicator, because those building permits are what ultimately result in construction occurring. So that's a bit of a negative. As we transition into the next component of the composite, the credit markets. So what's been happening kind of generally in the credit market?
Well, so interestingly, you know, in the dashboard, credit turned positive, and it really is reflective of what we're seeing, which is that the credit spreads are no longer inverted, meaning short-term rates relative to long-term rates were inverted, meaning short-term rates were higher. That is actually flipped, and we're seeing a more positively sloped yield curve. And so you can see in the green that the slope of the 10-year versus 2-year is now actually positive.
Perfect. How about spreads? Because I know those are important with the credit markets.
Yeah. You know, for the last couple of years, you know, we wondered whether, you know, spreads would widen. Now we did actually see generally they've come down. Now last quarter they did come up, but they've come right back down.
And the concern there is on the widening, just for folks that don't know. When they widen, that's a bad sign for the economy. And if we look here in the gray kind of bar areas, those are recessions, and you can see the lines, both of those two, jump up typically during those recessionary periods.
Yeah, and it's another way of looking at potential stress in the economy.
Got it. Perfect. So let's go to valuations, because we were talking about those as well. And here specifically under valuations, we're discussing corporate earnings.
Yeah, now they are projected to go up this year and next year. Now, obviously, the markets have done very well, and that's why valuations are high. We'll touch base a little bit later in the webinar, a little bit more on earnings estimates for the year and where we stand.
And then sentiment. So what are we seeing here?
Yeah, it's a little bit tough to see, but sentiment turned positive again. And the thing I'll show right on the far right side is you'll see that green line has actually turned back up and gone through the orange line. That's the 50-day moving average relative to the 200-day moving average. And from a trading perspective, it's viewed negatively when that 50-day line goes through and below the 200. So now it's actually recovered and is on above the 200-day, and that's viewed technically to be very positive.
Got it. So let's transition our discussion into the market. But before we do so, just to kind of summarize the economy, I'd say overall, as we looked at the dashboard and the various components, economy, pretty good. We saw valuations being the one component of the composite that maybe is a little bit negative, but everybody's benefited from that because of the higher markets. And that's where we're going to see some of the numbers as we look here. It's pretty obvious that the markets are up considerably. So this is Q2 data looking down. But if we go to the year to date, you're going to see really, really strong performance across the board. Small caps still haven't quite gotten back to break even. They're a little bit more interest rate sensitive. But these are year to date numbers, Jonathan. Like when we're looking at US large cap up 6.2%, that's not an annualized number. Or like the international market's up almost 18%. I mean, those are pretty ridiculous numbers if you would extrapolate that performance for the year.
And especially where they stood not that long ago during early parts of the second quarter.
That's a fair point. That's a very fair point. Now, the one thing I will mention, and we're going to get into when we talk about international, is a lot of that positive performance was currency driven. And we will touch on that in a little bit more detail. Here we're going to see the fixed income markets also positive. Obviously, global fixed getting a bit of a boost from the weak dollar and the currency conversion, with REITs slightly down and obviously commodities slightly down.
And I'll note on the commodity side that the Bloomberg Commodity Index has a lot of oil in it. Oil has been weaker. Obviously, gold and some of the other precious metals have actually been relatively strong this year, but that's why we're seeing a negative number in the quarter.
Got it. So here we're talking about the equity markets, particularly the US equity markets, and we're seeing that growth is kind of resuming its leadership position. So early in the year, we had value kind of looked like it was benefiting, but what we're showing is it didn't last long, I guess.
Yeah, and that's especially pronounced in large caps. You'll see that in small and mid caps, maybe not to the same degree.
Got it. So walk us through the sector performance and maybe why growth has resumed its dominance over value.
So if we look at Q2 returns, you'll see communication services and technology on the bottom half of the slide are up quite a bit. And that is really why growth resumed leadership, in the second quarter and now on a year-to-date basis. A lot of that was Mag 7, obviously communication services are other businesses as well. Consumer discretionary did have a nice bounce in the quarter. Certainly healthcare on the growth side has been an issue. That was actually negative in the quarter. So when we look at that relative to value had, industrials do very well. But again, as I mentioned, oil was weak. And so we saw negative energy performance.
And what I find interesting is if we look at year-to-date numbers and we look back at this time last year, a lot of what was doing good then is not doing good now, and vice versa. So for example, year-to-date technology is up 8%. Obviously had a really good quarter, but year-to-date was up 8%. Last year was up 28% at this point.
Yeah.
Healthcare, we're showing down a little bit year-to-date. Last year was actually up 8%. So it just goes to show how much the market can change in a relatively short period of time.
Yeah, absolutely.
Talk us through the international performance.
Yeah, so really when we look at the quarter and in the year, I think the biggest surprise for many equity holders is how strong international has been. And certainly the weak dollar that we saw in the second quarter contributed a lot to that. But we're looking at generally really good returns in Asia, Latin America. Europe has had a great year. China is a little more muted, but last year it actually did have a nice recovery year. And then you'll see that Japan is actually down a little bit, but last year was a very solid year.
Yeah. Again, what can happen in a relatively short period of time, to your point. Japan at this time last year was up 6.3% year-to-date. Latin America was down 15% this time last year, and now it's up 29% year-to-date.
Yeah, absolutely. And we'll touch a little bit later in the webinar on international and currency and kind of other factors to look at.
Got it. How about bonds?
Bonds had a nice quarter. What we'll see looking at Q2 is the left side has done well, and that's really the credit-oriented bonds. And as we mentioned, credit spreads actually narrowed during the quarter, which helped returns. But if we look at year-to-date returns, generally speaking, we're looking at things at 4% or more. The one that stands out is the municipal bond sector. There were a lot of technical features earlier in the year in April that led to this negative performance. We're going to touch base later in the webinar to talk about municipal bonds and the outlook, but we do actually think that the yields there are very attractive.
Got it. Yeah. And just to remain consistent with kind of a comparison to last year, Treasuries year-to-date up 5%. This time last year, on a year-to-date basis, they were down 2%. And that's in the bond market. That's a pretty wide spread.
Yeah, absolutely.
So as we look forward, first starting with the economy, here we're saying our outlook anyway is, tariffs are obviously going to continue to cause some uncertainty, particularly around their impact on the labor markets and inflation. Everybody keeps talking about how inflationary they are, but we have yet to really see it.
Yeah, it's interesting. We saw inflation come up a little bit this last month, but a lot of that still is coming from shelter costs and things like that. And so it's always going to be a question, how much of what we've already seen has been impacted by the tariffs versus how much is still to come. We do know, for example, with more recent announcements that the kind of effective tariff rate of putting everything together is now at 18%. Now, some of those haven't kicked in yet, but that is if everything in August stays where it is now, that's what it would be. But we've been running at a 10% tariff now for months, plus
Right.
a few of the other things. So some of that is in the numbers.
Fair point. And a lot less than when it was first pronounced in April.
Correct.
And there was concern that it was going to be,
Yep.
triple that.
Yeah, and the other issue is still consumer spending is just remaining robust.
Yes.
The labor market has really been very resilient in all of this.
Yeah. Yeah. Well, to your point, retail sales, I think the most recent were up like 0.6 month over month and 3.9 year over year. So as long as the consumer's out there, the economy's probably going to hang in there. And hopefully the recent legislation, whether you agree with it or not, it does bring certainty. And that's what the markets also like is, you may not agree with it, but the markets like to have known facts, and so do corporations. And then also with regards to the economy, you had made reference to it earlier. The Fed is likely to probably cut later this year. There's a little debate on how quickly they should be cutting. I think the administration's been pretty vocal on their opinion. Fed's not likely to probably follow their lead, but I do think cuts are likely the direction that we're going to be going at some point here. As far as the international economies, again, we'll have to see how the tariff situation works out in setting global trade and the direction of global growth. But a lot of countries are in the easing phase, probably a little bit earlier than what the U.S. is with our policy.
Absolutely.
So walk us through this, Jonathan, with regards to tariffs.
So basically on the left side, we're looking at growth forecasts. And so you'll see that declining red arrow, and that's just showing certainly in February, March into April, how growth forecasts were coming down relative to that uncertainty about tariffs. And then what you'll see then is those forecasts have started to actually come up. And interestingly, the one on the top, that's the US. And so we've seen quite a sea change even in a couple of months. And on the right side, we're looking at inflation estimates, and those have stabilized. And if you look at the dark blue, that would be the US. Now noted again, inflation did tick up last month, but again, nowhere near what the fears were so far.
So that was the economy. Now, as it relates to our market outlook on equities, volatility should be expected. I mean, almost always should be expected in the equity markets, but I guess we have had, a pretty wild ride here the last few months. I think April 8th was the low in the S&P, and at that point it was like 19% off its highs, and since then it's up 26%. And I recall having the conversations with some individuals like, this is going to be Armageddon, and who knows what's going to happen with tariffs. They could go up, to 100% or 200% or 300%, and we could be looking at a depression. But and the administration admittedly kind of shifted their perspective and moved off kind of their hard stance and started negotiating, which I think has contributed to maybe the markets easing back a little bit from their concerns. But downside risk certainly could materialize. I mean, we talked about the consumer. if the consumer pulls back because tariffs get worse than expected and inflation kicks in, consumers are keeping us out of a recession, and they could certainly put us into a recession. Corporate earnings, they could provide support, looks positive at this point. And international performance certainly is likely to provide that continued diversification benefits, although I wouldn't completely write off the U.S. exceptionalism at this point. Not to say that we're better than everybody in the world, but there has been a strong bias to U.S. markets over the last decade or two.
And actually, a little bit later, we're going to go through what has led to performance in U.S. stocks versus global markets, and I think we'll see that a little bit.
Sure. So let's talk about earnings, because that's so important as it relates to market performance.
Yeah, this is a little bit of a complicated slide, but let's look really on the right side of the slide. So the taller gray column is kind of where estimates were before the whole tariff concerns began, sitting at about $270 a share of earnings for the S&P. And then they've actually come down to, between 264 and 265 to kind of embed some of those expectations of things slowing. So the interesting thing, though, is we really haven't seen it in the hard data. Mm-hmm. And so if we look on the left, that's really kind of what people were expecting for Q1 estimates. And the taller blue column is what actually happened. So there were quite a few earnings surprises in the first quarter. The reason we're bringing this up, we don't know what will happen, but let's say that corporate earnings just continue to move forward and grow a bit higher than expectations, and the tariffs really don't impact that. What that likely means is on the right side, this 264 to 265 could actually work itself higher in the second half of the year. And again, it would provide support for the markets, if not provide a catalyst.
Got it. So that's the S&P, but let's transition back, flipping to our discussion on international and its performance relative to the U.S. and really the impact of dollar.
Yeah. So one of the things here would be the gray shaded portions. You'll see it in the middle, the far left and the far right are periods when the US dollar is weak. Okay. The purple, when it's kind of below, is when international stocks have underperformed. Okay. The periods that we're seeing outperformance of international stocks was really in the mid 2000s when the dollar was actually pretty weak, and we saw that positive performance. The reason we're just bringing this up is that what we definitely saw in the second quarter was a weak dollar. The dollar was down 10% relative to the euro, and we saw that translated into strong international performance. And then the question is, will that persist?
Got it. So let's talk about the US dollar trends then.
Yeah, so the trends, if we look on the left side, that's really the dollar trading going back to 2007. And you'll see starting kind of in that 2014, we saw a big move up in the dollar, and then we were kind of in a trading range for a number of years. And then post-pandemic, we saw another big move up in the dollar. And then more recently, you can see again that decline in the second quarter to now we're kind of out of what we were in a trading range. We're now kind of back into the trading range we were in the kind of 2015 to 2020 level. The question is, do we pop back up, or do we continue to see the dollar decline to kind of that lower red bar? If that were to occur, that likely would help international performance on a relative basis to the US. Now, the other thing I want to point out on the right side is that certainly flows into US stocks and bonds from foreigners can impact the dollar. Now, part of what we saw in this year is we've seen kind of flows come out. And that gets back into this whole argument about US exceptionalism. Is this more of a short-term issue, or is it potentially a medium-term to long-term issue? We don't know that, but we do know that if we do see flows coming from certainly Europeans who hold a lot of US assets, if that were to start to flow away from the US, that certainly would also help international equities.
Got it. Well, and the other thing I would say is markets generally can be volatile. Currency can be crazy volatile. So we do not really trade around currencies. And I think it's hard to even make a call on where you think currencies go, because it's such a difficult market. It's not just the US and what's happening with our deficit and all those things, but it's relative to what other countries are doing as well, because our dollar is obviously trading against currencies around the world. So I would just be very hesitant to anyone wanting to trade currency or make a call on currency direction, because it can be quite challenging.
Okay, so we had hinted that we were going to talk about the composition of international returns. So we're going to look kind of what's happened on a year-to-date basis. So if we look in the circle, that's really Eurozone equity performance. And that purple is the effect of currency. And so you'll see that that's a very, very large portion of the returns we've seen from Europe this year. So that it definitely currency helped. Now, as opposed to last year in 2024, that was actually more of an issue where we had dollar strength. And so currency actually negatively impacted Euro stocks, emerging market, and Japanese stocks. But, you know, there are some other things to note. One of the things you're going to see if we look at Europe is the other factors involved. And so if we look at the left, you're going to see that dark blue, that is earnings. And so that's the US last year. And so you can see the earnings growth last year. Now, if we look again at Europe, you really can't see the dark blue. It's a small component. And this gets back into, well, currencies can certainly help. There are other factors, and certainly we think earnings is a big factor, and that also leads to multiples. And so we did see the US multiple expand, and that's kind of that gray area. Now, one of the questions we did receive is tell us a little bit more about that impact over the longer time period. Because yes, we can correlate with the direction of the US dollar, but let's look in the last 15 years, how much of the dollar did really impact returns. And the currency impact, if you look at the right next to the US, that would be the Eurozone, you can't see that dark purple. Mm-hmm. So really, currency did not have a negative impact on the Eurozone stock price performance. I think the other thing we'll look at is the dark blue, and you'll see that that's much larger for the US than the Eurozone. And then again, that dark gray is much larger for the US versus the Eurozone. So one could argue that over the last 15 years, we saw a stronger earnings growth in the US relative to Europe. And as a result, we saw a multiple expansion relative to Europe. We don't know necessarily what that means going forward, but when we talk about American exceptionalism, I think that gets into it a little bit. So I think going forward, we're certainly going to need to see better earnings growth coming out of Europe. And Jamie Dimon earlier in the week kind of talked about Europe along those lines.
Well, and the other thing I wasn't planning on mentioning, but I'll just go ahead and throw it out there. Some investors who are very focused on dividends, I think, can be surprised when they see this especially say the 15-year data, where clearly more of the returns come from, in the international markets anyway, come from dividends versus the US.
That's a great point.
All right, let's touch on this one, Jonathan.
Yeah, we've had a good market. Now, obviously, we were down quite a bit and there was a lot of fear. But certainly May, we had a nice recovery. Then we look at June. June was actually, the S&P was up 5.1%. And when you've seen positive Mays and Junes, it has tended to point to stronger second half and 12-month returns. And if you can see in the circle that we're looking at roughly a 90% period where we saw higher returns versus 10% not. Now, of course, there are no guarantees. And if we look back to 2018, second half was negative in spite of that. So again, this just is a suggestion that the outlook looks good, but again, things could change relative to tariffs and consumer spending.
But even in 2018, the 12-month was still positive, up 8. Right. Not bad.
Yeah.
All right, and I had made a brief reference to this earlier, investing at all-time highs, because now that we are hitting all-time highs, people are a little bit reluctant to put any cash to work. But this is essentially showing us that all-time highs just basically lead into new all-time highs, and that it's really hard to predict when to try and time the market and deploy funds. On the right side, you'll see if you invested on any particular given day versus investing at the new all-time high, the differential really isn't that much.
No.
In the whole scheme of things.
The other side of it is how many times have we gotten calls when the market is down saying people want to invest cash?
That's a fair point. Not much. And that's investor psychology, right? I mean,
Yeah.
that's the way, our brains as humans, we tend to fear more the downside than get pleasure of the upside.
Right. And that's why we've shown slides basically saying that ultimately it's not timing the market, but time in the market.
Yes. Yeah. As far as our outlook on fixed income, we do believe bonds should continue to provide stability. Current bond yields typically set future fixed income returns, so yields have come up a lot. So we think future returns would be decent, and certainly better than maybe the last couple of years. Short term, expect interest rate volatility around the policy uncertainty that we've discussed. Fed's probably going to modestly reduce rates later this year. And as Jonathan already made reference to, we do believe municipal bonds are attractive despite the fact that we saw performance year to date not look all that great.
So here let's focus again in the circle, the municipal bonds. And so one of the things you're going to see is essentially the overall return, the taxable equivalent yield is almost 6% for municipal bonds. So that's higher than taxable bonds. Now, of course, you need to be in the higher tax brackets to enjoy that feature. But the other kind of major feature with them currently is, let's look at where they were in 2022. They were at 1.5%. And so when we look at this in a longer time horizon period, this is an unusually good time from a yield perspective to own municipal bonds. And the other side to that is we've also seen the slope of the yield curve for municipal bonds actually get a little steeper. And so that actually offers municipal bond managers the ability to kind of change the composition of their portfolio to take advantage of that.
And again, you've made reference to it, but I'll just reiterate, this is really for the taxpayers in one of the higher brackets. You wouldn't probably be, even with the attractive nature of these, if you're in a lower bracket, you probably wouldn't be buying municipal bonds. Which gets us actually into the new tax legislation and what is deemed the One Big Beautiful Bill Act, OBBBA, and talking about, you know, those higher tax brackets. The one thing that all of our clients will benefit from as a result of this legislation is the fact that the TCJA, the Tax Cuts Jobs Act of 2017, where they reduced tax rates at that point, those have now been made permanent. So all of our clients, rather than seeing higher tax rates starting in 2026, they'll benefit from the lower tax rates that have now been made permanent. If you recall, the TCJA also lowered corporate taxes in 2017. That provision was permanent, but the individual tax reduction was set to expire at the end of this year. So that's good news from a tax rate perspective. Increased standard deduction was part of this and also made permanent. As a matter of fact, all these items that I'm going to be discussing over the next couple of slides are permanent, like the increased estate tax exemption. That was scheduled to go basically in half in 2026. Instead, it's going to be at $15 million, indexed for inflation thereafter, and made permanent unless Congress were to act in passing new legislation that got through the administration. Bonus depreciation, this is the one component. I mean, there are several components that were business related, but this is the one I wanted to point out, only because it's a big deal. Reinstating 100% bonus depreciation, that is a big deal for businesses. Then we have AMT, which again, probably based on the legislation's not going to be impacting a lot of people. We've seen AMT with the TCJA in 2017 really not be a big issue with most of our clients. Miscellaneous itemized deductions, they were pretty much eliminated with TCJA, but again, now it's been made permanent. There was an addition though, a new deduction for unreimbursed employee expenses for eligible educators. I didn't put a lot of the details here, but if you have eligible educators out there, there is probably a new deduction that you could benefit from. The limitation on deduction for qualified resident interest, basically it stayed the same, but it's now permanent. So you're limited to 750,000. I think the number before TCJA was $1 million, maybe even slightly more than $1 million, but now it's permanently the 750. There were a couple things on ABLE accounts. So if there's anybody out there that is attending today's session and they might have children with physical or mental disabilities, ABLE accounts have been used for the last, I don't know, 5-10 years in those situations, and they can really provide some savings benefits for those individuals. So I'd encourage you, if you're in that situation, ABLE accounts may be a good option. Enhancement of child independent care credit, shown here. And then there was also the, let's see, new provisions that went into law. So these are all new. And not all of these are permanent. So as an example, the state and local tax limit, the SALT deduction, this is scheduled to expire at the end of 2029. So this is not a permanent adjustment. The other thing I'll say to this is for most of our clients, they're not going to get the benefit because this increased SALT deduction from 10,000 to 40,000 gets phased out. If you have AGI, adjusted gross income, of 500,000, your phase out begins, and then it basically gets fully phased out back down to the 10,000 deduction once your AGI reaches $600,000. So some people will get the benefit of this, but the higher income earners are definitely not going to see that benefit. There's also a reduction of itemized deductions. Now this one is permanent. So for the higher income earners, those in the 37% tax bracket, you're going to have some reduction of your itemized deductions. Charitable contributions, there's going to be some limits there too. So in 2026, you can, for those claiming the standard deduction, you can claim a deduction on cash contributions up to $2,000 for joint filers. So you don't even have to itemize to take a charitable contribution deduction if you're obviously taking the standard deduction in that situation. For those that are itemizing though, again, if you're in the higher tax brackets, you're going to see a reduction of your deduction. Charitable contributions now in 2026 going forward have to exceed 0.5% of your AGI. So there's a little bit of a floor there that you got to get over starting in 2026. So for some of our clients, I guess the takeaway there is maybe you want to accelerate some charitable giving into this year versus next year.
Mm-hmm.
All right. There's the new senior deduction for those 65 and older. Again, it's phased out though. So for 2025 tax year, if your AGI is 150,000 or more for joint filers, you start getting phased out of that deduction. So many people may not qualify for that. And it's also set to expire at the end of 2028. I just got an email in the last couple of days, actually a couple emails in the last few days on this one, the new tax on car loan, or the no tax on car loan interest. So you can now, starting in 2025, deduct up to $10,000 of car loan interest. There's limitations. It's on debt incurred after 12/31/24. It's got to be a certain vehicle, certain weight. It's got to be assembled in the United States. The key here is this is available as a deduction to non-itemizers, meaning if you're taking the standard deduction, you can get the benefit of this. But as with most of these provisions I've made reference to, Jonathan, there's an AGI phase out. So joint filers, as soon as your AGI gets above 200,000, you start getting phased out of this. So many of our clients are simply not going to qualify. And as I mentioned, this one, like many of the others that are new, will expire, and this one at the end of 2028. The infamous no tax on tips. So this did get included in the legislation, and you can now deduct up to $25,000 of tips. It's also available to non-itemizers, so those that are taking the standard deduction. The key here, though, is that those tips have to be reported on either a W-2 or 1099. And again, there's a phase out. Now this phase out's relatively high, particularly for folks that are probably receiving tips, but there is a phase out, and this also is set to expire at the end of 28, along with the no tax on overtime, which also expires at the end of 2028. So you can now deduct 25,000 of overtime for joint filers and 12.5 for single filers. Similar to what I had just discussed on the no tax for tips, there's limits on phase outs, etc. But it was part of the legislation as the president had campaigned on. This probably is not going to impact a lot of our clients, although I do know there's a couple of cases where it could, and that is limitations on wagering losses. This is a permanent provision, and essentially it results in not being able to deduct 100% of the losses up to the amount of winnings. So you're going to lose a little bit of a benefit that you've gotten in the past on that. Then the infamous Trump accounts, which are permanent as well. And frankly, there's just not a lot of information out there, Jonathan, on how these are going to work. We don't really have the details. We can tell you that there are eligibility rules. It will allow contributions to go in up to $5,000. That number will be indexed. These dollars will grow on a tax-deferred basis. I look at it almost like a Roth IRA, where you can put up to a certain amount in, after-tax contributions go in, but then it grows on a tax-deferred basis. Distributions can't be taken until the beneficiary reaches 18. And the government will actually, there's a pilot program, the government's actually going to put in $1,000 per child for those that are eligible, that are born between January 1 of this year and the end of 2028. How these accounts get set up, where they get set up, all of that to be determined. We just don't yet know. Only thing here that I wanted to mention on the 529 plans is that the distributions for K-12 expenses have been increased from $10,000 to $20,000. Now, I'll also point out, be careful, because not all states have adopted this. So in Minnesota, we haven't. So if you take out $10,000 or even say $20,000 from your 529 for K-12 expenses, yeah, there's not going to be that impact on the federal side, but that's not the case on the state side. And then an interesting one here that I know does impact a handful of our clients as well, an excise tax on remittance transfers, Jonathan. So I'm not even sure what the catalyst of this was, but for non-US citizens, if they transfer cash from the US to anywhere outside the US, there's going to be a 1% tax on that transfer. So you could be a permanent resident, a green card holder, but if you're not a citizen of the US and you're sending money overseas to family members or even to your own account overseas, there's going to be a 1% tax. Not all of the details have been ironed out, but it looks like that tax is going to be withheld by the financial institution executing the transfer. That's what it looks like at this point. So just be cognizant of that. Oh, and that provision doesn't go in until the 1st of January. So you do have a little bit of a grace period here between now and the end of the year that you could maybe send money over ahead of time. And another one that actually is going to impact several of our clients, the loss or elimination of these credits, the Energy Efficient Home Improvement Credit, the Residential Clean Energy Credit, and the Clean Vehicle Credit. The top two, the Energy Efficient Home Improvement Credit and the Residential Clean Energy Credit, those expire at the end of the year. So if you're working on a house project, as long as you have that completed and operational by the end of the year, you should still qualify for these credits. The Clean Vehicle Credit, though, that expires September 30th. So if you're looking to buy a qualified clean energy vehicle, you've just got a few months here to get that done. Now, remember, not everybody even qualifies even under the current rules, because there's an AGI phase out of that credit under current law. So again, maybe the higher income earners, they're not even eligible for it now anyway. So with that, Jonathan, I've done a lot of talking. Why don't you give us a couple of SilverOak updates?
Okay, so kind of a review of the IQ's funds. It's been a good year, and certainly when we look at U.S. returns, the large cap funds have done well. So both growth and value are having a good year. When we look at U.S. mid cap and small caps, that's a little bit of a different story. I'd say, certainly small caps at the end of the quarter were still down a little bit. Mid caps were up a little bit. Not surprisingly, we talked about international returns, and our international investments are having a good year on a relative and absolute basis. And then from a fixed income standpoint, I'd say that, again, our core funds, our credit-oriented funds, and our non-traditional and global funds are all having good years. We hit on municipals. That performance has not been as good, but again, from an outlook standpoint, they provide good yields. And generally, as credits, municipals look to be in fine shape.
Perfect.
And then just on a operations basis, we did add 2 new team members to the SilverOak team. We hired a new operations specialist who's actually already working. And then we've extended an offer to an executive assistant who will be beginning in early August.
Excellent. Well, thank you, Jonathan. And again, thank you for the entire SilverOak team for putting the materials together and making this webinar possible. And thank you, everyone that attended today's webinar. We appreciate your involvement and do appreciate any questions or suggestions for future webinars. So feel free to reach out to us with those comments. If you're not working with the SilverOak advisor, feel free to give me a call at 952-896-5701. But again, thank you for attending. We really appreciate you taking the time to do so, and wish you a great day.